Hi friends, I hope you're fine and I'm really excited to share this investing art with you and I hope you are enjoying the entire series. Just remember one thing friends, that these 5 rules that I'm going to recite to you, these are the foundation of the entire investing. I tell you what, these are the most important 5 basic rules across investment world, across the books, across the research, across the 100 years of financial markets, stock markets journey. You cut across every dimension, and you will find that these 5 rules are working perfectly in everywhere. So friends, in the series today we are going to talk about the third rule of investing, which is equally important. Friends, sometimes these rules can sound boring to you. I can understand that. The reason is that every knowledge which is truthful, which is research based, looks a little boring because that is what the purpose of that. It's not fabricated in a fashionable manner. No, if you have to sell something, then you have to market it, we package it in a beautiful way, just like those CNBC and Business Newsline and other TV channels are doing to sell you some stocks which are not worth a penny, but they are just describing it as beautifully as possible. The point is here is that as an investor, as a smart investor, you must rely on those 5 rules before you make any kind of investment decisions, right? And I bet you, I assure you, I guarantee you that you will save yourself from losing money and for your entire life. All right, friends. So in this series of 5 rules of investing, today we are going to discuss the third rule of investing. Now, just before we move ahead, let me just rephrase the first rules. The first rule was that you should not consider a stock just like an electronic symbol. It has an entire business behind it. All the products, goods are sold, people are working there are machines, there are plants, there are so many processes. So the business is doing their services and products, making the products and earning money, and through that they are growing. So the stock symbol is not just a symbol, it is actually an entire actual business, right friends? So always consider studying the financial reports, financial statements, company background, management quality, and so many other factors before parking your important hard-earned money into that stock. So that was rule number 1, right? How will we do it? We will talk about it in depth, and I assure you that I will give you every small little understanding of the stock market working, right? Now coming to the rule number 2. The rule number 2, what did it say? If anybody remember? All right, friends, I can understand that there is memory which is always filled with so many Instagram and LinkedIn and different kind of things. So I just help you with that. The second rule was that when you when you consider buying anything from the stock, then the stock is considered connected to its stock price, but the intelligent or the smart investor is someone who buys from the pessimists and sells it to the optimists. The point is, the stock market prices are moving just like this, and the intelligent investor is someone who buys at the lower price when everybody is selling, and he sells when everybody is buying. So he buys at low and sells at high, just opposite the market, and he makes a lot of money while others are losing a lot of money, right? Now coming to the rule number 3, which is very important, very important. So friends, let's talk about that. The rule number 3 is here on your screen now. It says the future value of every investment is a function of its present price. The point is that the higher you pay, the lower your returns will be. Now, what does it mean? It simply means, on your screen you can see the rule number 3. It simply says that the future value of anything depends on its present value. So, if I have to explain you this thing, This simply means that suppose some business or some stock is worth rupees 100 and now it is being sold at rupees 500. So the stock's book value or the asset value of that particular share, I just want to go a little easier for you. Just to help me, let me help you. Let's consider there is a business which is of, say, suppose 10,000 rupees worth. For example, it may be 10,000 crore rupees, but I just consider 10,000 rupees. Or maybe let's consider, for simplicity, a business is worth 100 rupees and there are 100 shares of that business are being floated across the investors. So one share has 1 rupee of that business attached to it, right? Now that is called the book value, the asset value behind that particular share. In simple words, if I say that today the business is sold, or maybe I say it is auctioned, at that time the whatever value the investor or the company will get after selling their entire business, that will be distributed amongst all the shareholders. Then whatever each value investor or each share will get is its book value in simple terms. So the value, the worth of the one share of the company is, say, rupee 1, because there were 100 shares and the 100 rupee was the price of the value of the entire business. If that is sold, then every shareholder with every share will get 1 rupee. So suppose tomorrow you have 5 shares, then you will get 5 rupees from that company in case the company is liquidated, it is auctioned, the business is sold or something like that. That is the part number 1. So now suppose you know the worth of that business is 1 share should be equal to rupee 1, right? Next, now there can be 3 possibilities in the stock market. Now the same share is sold at, say, 5 rupees in the market. Okay, so the market value of that share is rupees 5 and shareholder value, or I should say actual value, is rupee 1. So that simply means that you have to pay 5 times more to acquire the share of a company whose value is rupee 1. Simple enough? Any doubt? Okay. Now, would you be doing that? That you want to buy 1 rupee worth of thing by paying 5 rupee for it. So the stock is a little higher on value price, right? It is called overpriced stock, right? Now, there is another possibility. The shareholder share value is equal to the market value. So the 1 rupee price share is sold at rupee 1 in the market. So should you buy it? Yes, if the company is good, no problem in that, right? But in first case, when 1 rupee worth share is actually sold at rupees 5 in the market, then you need to think that you are paying 5 times more. So is it something which you should do? Do some analysis, think about it, and then take a call. So that is second number. Third possibility is that the share price, the worth of a share is rupee 1. But due to the pessimistic reactions or panic reactions of investors, the stock price has come to rupees, say, 50 paisa or half a rupee. So the actual business backing behind the share is rupee 1 and the share price, market price, is 50% of that. That is 0.5 rupee, right? If that is the case, then you should immediately buy that stock. Why? Because if the company is sold on the spot, even if you don't have anything to do with that, if the company is auctioned or sold or anything is done, then you will get at least 50% more, 100% more return on that. Why? Because you are paying only 50 paisa, half a rupee, for a business which is 1 rupee cost. So that is called the value investing technique. You are investing for higher value, right? So the rule number 2, what does it say? 3, what does it say? It says that the more you pay, the less you get. That simply means that suppose a company is today rupee 1 cost, one stock, one share is worth rupee 1 and you are buying it for rupee 5, okay? And considering the business growth, suppose after 1 year the stock price should reach up to rupees 8, right? So if you pay for that for 5 rupees for it, then you will have only 3 rupees to earn on that, right? But if you buy that stock on such a level when 1 rupee share is market price is also 1 rupee, then you will have 7 rupee to earn on the same stock. Simple words if I say, simply means that if you buy any share at lower price, then your return would be higher. If you buy the same stock at higher price, then your returns would be lower. Now, how would we determine that? How will we judge that? For that, there are so many hundreds of techniques, tools, and tricks, and I will be helping you out throughout understanding that in the coming videos. But in nutshell, what I can say is there are some factors just like price to earning ratio, there is PAG ratio, and there is a market price ratio. So many ratios are there, so many calculations are there, so that you can judge that how much you are paying. The best and the easiest method is price to earning ratio. So if, say, suppose price is actually market price and earning is the profit behind one share. So if the price to earning ratio is smaller, then the stock is sold at cheaper prices. You should go and buy it. Though consider that that is not just one of the criteria. That is just one of the criteria. There are so many other criteria, but that also has to be considered. But this is an important thing, that you buy PE ratio, price to earning ratio, you get to know that if you are buying an overpriced stock or an underpriced stock, right? So rule number 3 says that the higher you pay, the less return you get. Simple enough, right? I again repeat, the higher price you pay, the less return you are going to get. So the future price of any product or any stock is completely based on the present price that you pay for it. Simple enough. So this is in nutshell rule number 3. I hope you understand. I will bring the rule number 3 along with rule number 1 and 2 on your screen very soon. So quickly look at the screen. So this is the rule number 3. This simply says the future value of every investment, future value means from today, after 5 years or 10 years or 2 years or whatever, is completely a function of. That simply means that it depends on. Function means it depends. What is a function? Function is input and output connected through a rule, that is called function. So the future price is a function of its present price. So the higher the price you pay, the less or lower your returns will be. So do not forget this rule number 3. Never overpay for any stock, however interesting it may be, right? So again, with rule number 1 and 2, I'll just quickly take you through. So what was the rule number 1? The rule number 1 was that stock is not just a ticker symbol or an electronic bill. It is an actual ownership interest in an actual business, the business where the people go and buy and sell things with an underlying value. That does not depend, the value does not depend on the share price, right? So that is point number 1. Now what is value? Value is worth of the business, overall cost of the, I should say, overall net worth of the business. And what is the stock price? The price that you pay to buy this ownership interest in that business, right? So the point is that every symbol is actual business, not just a symbol. Second rule, it simply say the market moves like a pendulum from this side to this side, from so many happy people excited with so much of enthusiasm and saying, I want to buy this stock, this is the best stock, this is the amazing stock, this will break all the records in the coming future, this is an internet stock, this is an e-commerce business, this is pharma, this is this. So there are so many excited people who want to pay any price for any stock, right? And there is another group of the people who are completely sad, pessimist, upset. They simply say, oh, the stock market is bad. I have to sell everything because I don't want to make losses. I already have booked losses. Now, what does the smart investor do? He buys from those who are sad and negative, those who are selling their stocks at the lower price because they consider it is going to be failed. So you buy from them and then hold it and wait for the exciting people to show their face. When they start coming in for buying that stock at higher price, you buy the same stock to them at higher price and you make money in between. Isn't it simple enough? Sounds interesting? Wonderful. And the rule number 3 says that the future value of anything depends on its present value. That simply means that if you buy something at today at some price, then the future return will depend on today's price. Because if you overpay, then your returns will be lower. But if you underpay, then your returns will be higher. So these are the three rules so far we have covered. Friends, I hope you might have enjoyed this. Please let me know in your comments in your comment section. And what better we can do? I can share so many examples from the real case studies, from the real stocks. I can do complete stock analysis from fundamental to technicals to chart patterns to financial statements to annual reports to ratio analysis. Everything I can do it for you, but we'll cover that in coming days. So far is the most important and maybe somewhat boring portion that I'm covering. Upcoming lectures, upcoming videos will be having interesting, exciting stuff where you will see the real stocks are being analyzed in the real-time manner. Friends, I hope this research-based content, this actual, truthful, insightful, unbiased investment knowledge that I'm bringing it to you, I hope you like it. If so, please let me know about that and like the video. And yes, if you have not subscribed this channel, then please subscribe this channel right now and click the bell icon so that my next videos will be there as soon as they are released, they are with you. Friends, let's meet in the next video. Till then, enjoy investing, happy investing, and have a wonderful time. Take care. Bye-bye. Thank you.